Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Welcome back to the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. A slightly different format with no actual live video this week as our office that houses our studio is being remodeled. But hey, it was a good week for the markets, and we'll actually dig into the numbers here in a bit. But it's the same story this week that we've seen for almost the last 5 years. It was the tech sector, or in Dave Ramsey language, the growth portion of the market that was the main driver behind this week's market gains. Despite the fact that the FOMC, the Federal Open Market Committee, they had a meeting on Wednesday of this week, and they cut back their projected rate cuts for 2024. How many times are they going to drop rates to just one? At the meeting, they decided to maintain their benchmark lending rate, and they revised their economic projections. And part of that revision was indicating that there was only going to be one single rate cut for the entire year, which is a reduction from about 3 that were forecasted in March of this year. And probably around the beginning of the year, the market was anticipating about 7 rate cuts for the year. And for all the rate cut changes, are we going to do 7? Are we going to do 3? Now down to 1. The market has hung in there pretty well. Now this week, as I mentioned, the sectors that did well were led by the technology sector. That was up about 6.4%. But also you saw real estate and communication services rising about 1.2 and 0.9 respectively. And the consumer discretionary sector was slightly positive as well. If you actually looked at some of the stocks that drove that large technology increase, it was Broadcom, that their shares surged 23% for the week after the chip maker raised its full year revenue forecast, and which was driven by a strong fiscal second quarter and high demand for, you guessed it, artificial intelligence and VMware software. How about another name that did pretty good in the tech sector leading to their outperformance? It was Oracle. Oracle shares contributed to the tech sector's strength, climbing 9.7%. And the software company provided an optimistic forecast for annual growth in its fiscal first quarter revenue and earnings. They also announced new cloud partnerships with OpenAI. They're the company that's doing a lot of the artificial intelligence, including ChatGPT. And they also announced cloud partnerships with Google, despite reporting lower than expected results in the previous period. So how about that? 2 names that are rising in the tech sector that are not NVIDIA, Google, Meta, or Apple. The sectors that fell last week were the energy sector. They fell by about 2.3%, followed by declines of 2% in financials, 1.2% in consumer staples, 1% in industrials. Materials, healthcare, and utilities also were slightly down. And what's going to be reported this week that we'll probably talk about on next week's video? Well, that's going to include the May retail sales and industrial production. That's going to be reported on Tuesday. The May housing starts and building permits are going to be reported on Thursday, and May existing home sales on Friday. So big week for real estate in regards to data releases. And they're going to help confirm or deny the fact that the economy is strong, but probably slowing, and will more than likely not move the markets too much one way or another, in our opinion, because these just aren't very widely watched data sets like inflation is right now. Now let's dive into our weekly roundup of data that we look at each week, which starts with the Atlanta Fed's GDP Now model, which tracks the growth of our economy in real time. Now, guess what? There's not actually anything to update here because they didn't make an update this week. Their next update is going to be Tuesday, June 18th. So the number still stands at 3.1%. But after the inflation report this week, it's my estimation that you'll see this number look a tad bit better when we get that update on Tuesday, or at least similar. Next, we have the 15-year and 30-year mortgage rates that we check each week to gauge how well they are doing and giving us an indication of improvement in home affordability amongst consumers. Some might argue, well, if rates actually do go down, you're just going to get more supply, which is going to drive prices up, and that's not going to change home affordability. You'll just get higher and higher prices, even though you'll have lower and lower rates, because it'll bring so many buyers back to the market. Not so much supply, I should say, but it will bring supply for sure, but it also bring a corresponding large amount of buyers. We disagree with that sentiment. We think lower mortgage rates, while that will bring more buyers and more supplies, those should equal out, and home affordability will slightly improve with lower mortgage rates. And this week, the numbers inched down to 6.17% on the 15-year number and 6.95% on the 30-year number. Next, each week we look at the initial claims for unemployment insurance to gauge if we are starting to see problems in the labor market, because these are the people that are losing their jobs, not able to find a new one, and going on unemployment. This week, those numbers did climb to 242,000. So we'll look forward to continuing to watch this and track it to see how this trend plays out. But after a strong jobs report last week, one would think even if someone were to go on unemployment, they can get off it quickly. And we can actually validate that by looking at the continuing claims for unemployment. And that has fallen from a recent top of about 2.1 million people earlier this year down to about 1.71 million in the last 6 months. And finally, the markets. This week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, that had a positive week by returning 1.35% for the week after the positive inflation data. However, the Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, that was negative 1.29% this week. And the MSCI EFO, which tracks international stocks across the globe in developed nations, excluding the United States, that was negative 2.47% this week. So a wide range of outcomes for the four categories, with growth and growth in income, or the S&P 500 taking the prize. How about point number 2? Let's talk about sentiment. How are you and how are the consumers feeling right now? Well, we talk about it a ton on this video series, but the University of Michigan does one of the most popular sentiment surveys in the country. This month, it fell to 65.6 in June from 69.1 in May. This is the lowest reading since November of 2023. And although it's down, this reading was a statistically insignificant 3.5 index points below May and within the margin of error. Consumer sentiment is still to be optimistic, about 31% above the June 2022 levels. And of course, that was when inflation was at its worst and people were very pessimistic. Assessments of personal finances dipped in June due to modest rising concerns over high prices and weakening incomes. We're not getting the raises we were seeing earlier last year and the year prior. Thus, consumer sentiment falling a bit on that. How about point number 3? The biggest news of the week. The Consumer Price Index reported mid last week, and it remained unchanged in May of 2024 compared to a 0.3% increase in April of 2024. That's right. The reading came in at basically 0. I mean, it rounded down or up to 0.1, which means there was essentially no inflation for the month. So this does not mean that everything goes back to what it cost before inflation reared its ugly head 2 years ago. No. Things still cost more than it did 2 years ago. But there is no material inflation to speak of this previous month. It was flat, and that's a wonderful thing. You get flat for a year, you're at 0% inflation. Now, that's not going to happen, but that's where we're at this last month. The index for all items less food and energy, and that's referred to as core CPI, that rose by 0.2 in May of 2024. And the CPI, as we've discussed in the past, measures changes in the prices paid by consumers for a basket of goods and services. Not necessarily a basket of goods and services you're buying, like PCE looks at. That's why we like that better. But CPI is a very broad measure of inflation. Thus, a higher or a hotter number suggests prices are increasing for consumers, and a lower number would suggest prices are stagnant or possibly even going down. Very rarely do you see them go down, though. Wall Street projected a 0.1% monthly gain and a 3.4% annual gain for May of 2024. making the actual figures lower than anticipated. Excluding food and energy prices, which again is the core CPI, that increased by 0.2 month over month and 3.4 year over year, falling short of the respective estimates of 0.3 and 3.5. And falling short when it comes to inflation is a good thing. The lower than expected inflation figures, particularly in the core measures, led the stock market to have a very nice day when this was all released. And you actually saw interest rates, as reflected by Treasury yields, declining, which was another good point. The lack of change in the CPI for May 2024 can be contributed to several factors. The reason it didn't go up, well, shelter index rose by 0.4 for the fourth consecutive month, but a decline in gasoline prices offset that increase. The energy index, which is part of the CPI, that dropped by 2% due to a 3.6% decrease in the gasoline index. The food index increased by only 0.1%. Now, the Federal Reserve is responsible for monetary policy in the U.S., and they consider inflation when they're making their interest rate decisions, which is why this has such a big impact on interest rates. CPI does, inflation does. The FOMC, the Federal Open Market Committee, which sets interest rates, they met on June 12th, the same day that this CPI was actually released. Now, presumably they got it way before the number was actually released, but it was coincidental that they were released on the same day. And the market participants widely anticipated the Fed to maintain its benchmark interest rate as they saw indications regarding the future direction of monetary policy. And you'll just have to find out on point number 4 what the FOMC actually did. Now, there was another inflation number that was released this week, and that's wholesale inflation as measured by the Producer Price Index. And that cooled significantly in May, with prices down 0.2 from April's 0.5 increase. The PPI measures the change in prices that manufacturers pay to suppliers, and that rose 2.2 if you looked at it on an annual basis, a 12-month basis ending in May. That matched April's increase. Wall Street had anticipated a 0.1 rise in monthly wholesale inflation and a 2.5 annual rise. A 4.8 decline in energy prices was a major reason and contributor to the decline in the overall wholesale prices last month. And the May decrease in final demand prices can be attributed to a 0.8% decline in the index for final demand goods. Prices for final demand services were unchanged, and PPI captures average price shifts before they reach consumers. And so it's a potential bellwether for what we're going to get at the retail level of inflation in the months ahead. Meaning, if PPI looks good, it's highly likely, not guaranteed, highly likely that CPI is going to look good in the future. So seeing this number come in so low, very, very good. And finally, point number 4, the Federal Reserve, the FOMC meeting, that happened this week. Now, what did they do with the interest rates? Well, status quo, as you can see on your screen. The Federal Reserve opted to maintain its current interest rate range of 5.25 to 5.5% at the June 2024 FOMC meeting. While acknowledging modest further progress towards its 2% inflation goal, the Fed revised its outlook for rate cuts to just 1 in 2024, as we mentioned in the offset of this video series, down from the projected 3 in March of 2024. This decision came after the release of May's CPI report, which we just talked about in point number 3, which showed inflation holding steady from the previous month. Although restrictive monetary policies seem to be working, the Fed is not ready to start cutting rates yet because they want to see more data before making that commitment. Federal Reserve Chair Jerome Powell, speaking at a press conference following the meeting, emphasized the need for more good data, wants to see more indications that inflation is coming down to be confident that they're working towards that 2% target. Powell stated that the recent string of inflation readings shows signs of cooling price pressures and that long-term inflation expectations seem to be well anchored, but still it remains too high for their liking. Even being at 3% year over year, it's just not good enough. He also noted that while May's CPI report, which showed flat monthly inflation, was factored into the Fed's projections, a single data point is not good enough to change their stance. The Fed aims to balance its goal of lowering inflation while maintaining economic growth and managing the very strong labor market. Those are the things that they're worried about. They're not actually worried about the stock market, even though their decisions impact it quite a bit. No FOMC committee member anticipated raising rates. And Powell said the current belief is that maintaining restrictive policy, meaning keeping their rates the same, will ultimately lead to a weakening economy, prompting future rate cuts. So eventually, if they stay where they're at, it'll slow the economy down enough that they will start cutting rates to spur it back up. While not ruling out future rate hikes, Powell emphasized that no committee member currently foresees that outcome. So nobody's expecting to have rate increases, which was starting to be talked about when inflation started to come back up. But after the last few months of inflation leveling out and coming down, that is no longer the thought process of any committee member. He also suggested that the recent positive jobs data might be overstating, hinting that he thinks there might be potential downward revisions on those numbers. Because as we get those numbers, those labor market numbers, they do adjust them as they refine the data and receive more data after the release of the data. So does he know something we don't know? Are those job numbers going to get revised down? Sounds like it from the press conference that he held. So thanks so much for watching this week's video. If this week's video was helpful to you, would you do us a favor? You can do us a favor by hitting the like and the subscribe button. When you hit the like button, that helps push our content out to more people on YouTube and Rumble through their algorithms. And when you hit the subscribe button, our content gets released to you as we release it. So thanks so much for watching. And if you'd like to meet with any of our financial coaches or advisors, you can go to the comment section of this video. And in the comment section, you can hit on the link that will allow you to meet with our coaches who help you in baby steps 1, 2, and 3, and our financial advisors and planners who help you in baby steps 4, 5, and 6. So eventually you can get to 7. They'll help you figure out your retirement saving strategy, figure out your college saving strategy, and help you work on a plan to pay off that house. So eventually you can live and give like no one else. Thanks so much for watching this week's video.